I studied investing for 10 years and grew my investment portfolio from £400 to over 6 figures. I've read well over 100 books, and today I wanted to condense those learnings into 7 really important things that you need to know about. And if you follow these 7 principles that I'm about to share, then there should be no reason whatsoever why you can't grow your investment portfolio to over 6 figures and beyond too. If you study any successful individual, whether it's a professional athlete or a really successful business person, they always have one very simple thing in common, and that's that they mastered the area of specialism that they're looking to be successful in. It's why you see Lewis Hamilton staying late to study the data to help come up with the perfect car setup for the race weekend. It's also why Warren Buffett reportedly reads for 5 to 6 hours a day to better understand the markets. Now, I certainly haven't mastered investing, certainly not by any shot, but there is a reason why I started learning investing at the age of 18 once I joined university, but I didn't actually make my first investment until I turned 21. Well, actually, there's probably 2 reasons. Firstly, because I couldn't invest my student loan and I had to wait until I'd secured a graduate job in order to earn an income to actually have that money to invest. But secondly, and most importantly, I had to learn how to invest before I actually took my hard-earned money and put it at risk in the markets. As quoted in the book, The Warren Buffett Way, risk only comes from not knowing what you're doing. So the first piece of advice I've got for you guys is to pick up a couple of books. I'll leave some recommendations down in the description below, but be sure to learn how to invest first, because investing in yourself and your own knowledge will be the thing that pays the best return on investment. Investing certainly sounds complex, especially if you're kind of new to the game. However, the reality is one of the most successful investment strategies is to quite literally keep things simple. Now, it's probably quite appealing to invest into individual stocks, especially the ones that you think have the potential to 10x in a short period of time, or perhaps even the stocks that have 10x'd in most recent history. But truth be told, 90% of professional fund managers actually just failed to beat the overall performance of the stock market. It's why John Bogle says in the little book of Common Sense Investing, time, patience, and a simple, low-cost, diversified portfolio are the investor's best friend. It's the reason why I personally have roughly about £20,000 of my own investment portfolio allocated to a low cost, which has an expense ratio of 0.07%, S&P 500 ETF. I get all of the benefits and the upside from broad market diversification whilst paying very little in fees along the way. And I'm also beating the returns of 90% of professional fund managers, which is a pretty good place to be in. So don't overcomplicate your investments, because the reality is you don't need to in order to be successful in the markets. If you're perhaps a moderate to conservative investor, well, this part's for you. There is a very well-known investment strategy called cost averaging, or the Americans call it dollar cost averaging. It's whereby you invest money into the market during regular time intervals. And you can, of course, do this manually, but I would encourage every single one of you to actually look at something called an AIP, which is an automated investment plan. It's where you invest money automatically every single month without fail. And because of that, it means I get time diversification because my investments are spread out gradually over time. And because of that, it also means that I also get to benefit from fluctuating market conditions. It's a strategy that's recommended by Burton Malkiel, who's the author of A Random Walk Down Wall Street, who says that regular monthly investments, no matter the level of the market, are a painless and productive way to reach your financial goals. So if you've got aspirations of gradually building up your portfolio over time, just like I've done, then this strategy may be the one for you. It's how I was able to start out with £400 and get to the position I'm in today. One of the most common downfalls of newer investors is that they never go on to complete and understand both quantitative and qualitative analysis. On the quantitative side, you've got things like a PE, PB, PS, you've got things like the current ratio, a balance sheet, a profit and loss account, net assets, and the list goes on. And then on the qualitative side, you've got things like political, economic, technological, competitor, as well as management factors that you need to take into consideration. If you don't have a relatively good grasp on all of these variables that go into understanding a business, then you're not ready to invest in that business. Benjamin Graham famously said in his book, The Intelligent Investor, the stock market is filled with individuals who know the price of everything, but the value of nothing. And it's probably true, perhaps even more so now than ever before. And he wrote this book back in the day where in order to get hold of stock prices, you had to either read the newspaper in the morning or call up your stockbroker. Long before the days of a simple Google search was a thing. But because of this ease of accessibility, you can simply make a quick Google search, see the overall performance of a stock over any given point in time, and if you go on and see that that stock has performed quite well, most investors can be enticed straight in just on stock price performance alone. And stock price performance isn't the only thing that dictates whether a business is going to be successful or not. In the past 97 years, we've had 11 bear markets where the market has declined 20% or more, with the worst of these crashes being the Wall Street crash of 1929, where the stock market fell 83.4%. Now, based on those statistics alone, you may be somewhat panicked about investing into the stock market, especially with the continuous array of doom and gloom that we see in the mainstream media. It kind of makes you think just how healthy the global economy actually is, especially when you've got headlines about a cost of living crisis, threats of a recession, big potential bankruptcies, political unrest, and wars going on all around the world. But despite that being perhaps a perception, the reality is that the market always performs. Because whilst the average bear market might last 1.3 years for an average decline of 38%, the average bull market on the other hand lasts 6.6 years for an average gain of 339%. So staying invested in the market is absolutely imperative, despite what's going on in the broader macroeconomic and political environment. Peter Lynch wrote in his book One Up on Wall Street, the key to making money in stocks is not to get scared out of them, and he couldn't be more right. Because if you'd missed just the best 30 trading days in the market between 1993 and 2022, your investment returns would be 83% lower than someone who just stayed invested throughout whole duration of time. So if that's not food for thought when it comes to long-term investing, then I don't know what is. The average rate of return of the US stock market adjusted for inflation is about 7% per year. Now, if you were to invest £500 per month into a US market tracking index and you were to do this for 35 years, you would have an investment portfolio value of £1,132,000. And from that, you'd be looking at quarterly dividends of £3,792. Now, if you're under the age of 35 right now, then you absolutely have the potential to hit these kind of numbers by the time that you reach retirement. And if you're older than that, it really doesn't matter, providing you've still got a long enough investment time horizon. And that's because Warren Buffett made 99% of his net worth after the age of 50 and is now at the ripe old age of 93. And is worth over $100 billion. It's the reason why Albert Einstein says that compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. So get your money working for you, because as it says in The Richest Man in Babylon, make your money your slave. Simply look to invest in productive assets that produce profits that can either be reinvested back into the business for future growth or can be distributed to you as a shareholder. That's how you get your money to work for you without actually having to do any of the work. When investing, there is this notion that you shouldn't put all of your eggs in one basket. And what I mean by that is that you shouldn't go all in on one stock, or perhaps arguably even one asset class. Because as William Bernstein writes in The 4 Pillars of Investing, diversification is the closest thing to a free lunch in investing. Because when you're diversified, your risk exposure reduces. It means you're not reliant on a single company or a single investment to provide you with all of your investment returns. And instead, the aim should be to build up a portfolio of stocks, whether individually or across a market tracking index, in order to actively diversify your portfolio. So how many stocks should you hold? Well, according to studies, the magic number is around 15 to 20. And actually you can see the standard deviation of a portfolio reduces massively the more you diversify, until you hit that point of about 15 to 20 stocks, and for every additional stock you add thereafter, the benefits from doing so from a risk mitigation standpoint become proportionately less. Now, if you're able to successfully deploy these 7 principles that I've learned from reading over hundreds of books and spending thousands of hours researching the topic of investing, then you should certainly be able to go on to reach all of your financial goals. If you invest regularly and diligently and have a plan outlined, then you certainly won't go far wrong. It's what I've been doing over the past 7 years, and I've now got tens of thousands of pounds invested into equities, and even earlier on this year, I diversified into a whole new asset class and bought my first investment property. So a 10-year journey where I spent roughly 30% of my time learning my craft before I executed has resulted in 90% of my successes. And if you want to know where I can attribute the other 10% to, well, I also made a video about how normal people working normal jobs can actually become rich. So be sure to check that video out now, but before you do so, be sure to subscribe to the channel, be sure to drop a like on the video as well on your way out. And with that being said, see you over in the next one.